Howdy, Jacob here. Today we're looking at the company, the Azek company in the building products industry, 6.8 billion market cap, 7.1 billion enterprise value. They engage in the design, manufacturing, and selling of building products for residential, commercial, and industrial markets in the United States and Canada. Pretty good growth rate. Most recent year was pretty low, but outside of that, you're looking at double-digit growth rate on revenue, gross margin increase, now in the 31% range. Operating margin, really 9 to 10%, pretty solid, but pretty poor return on invested capital. Their income statement shows really that their shares increased quite a lot, but they've repurchased some more recently. Balance sheet has 278 million cash on hand with 580 million long-term debt, down quite a bit from 5 years ago. So they have been reducing their their debt on the balance sheet. And use of cash is really a heavy amount of share repurchases and then acquisitions with a little bit of debt pay down. So that debt amount of 580 million is really only 300 net, and production of free cash flow recently is very high, but outside of the rolling 12, capital expenditures are actually catching up pretty heavily with the cash from operations. So we'll have to see whether the most recent year and rolling 12 are going to be the new future with very solid production of free cash flow, or whether your capital expenditures are really going to offset your cash from operations. Let's start making some assumptions here. On the revenue growth side, maybe 5%, and then probably a little bit lower than the average for a business because margins aren't that crazy impressive. And then I don't think growth at the end of 7 years is really going to be that impressive. Let's do a little bit of a range here, maybe a 5, 4, and share change of, they buy back quite a bit. 1% would be about 68 million. 2% would be about 130, 140, 150 to offset stock-based compensation. Let's try that. So, whoa. We get to a price that needs to fall 93% to get to the price we're looking for here. That kind of surprises me a little bit. I mean, I know 57% is the current PE. We're saying it goes down to 13 with essentially the same margin on the net income side, but I don't think there's going to be that much growth here to where, at least from what I'm seeing right here, I don't see a way they can get immense growth. And I mean, they don't look to have a great return on the money reinvested back in the business as of now. So, I mean, to me, this just looks incredibly expensive. But yeah, hope you enjoy the review and have a great day. Thank you.